picture this. It's the early 1920s in Weimar, Germany.
Okay.
A housewife is walking down a cobblestone street. She's pushing this wooden wheelbarrow,
Right.
but she's not hauling dirt. She's not moving bricks. That wheelbarrow is just piled high, overflowing with cash.
Just massive stacks of paper money.
Exactly. Stacks and stacks of paper marks. And she's bringing all of this physical currency just to buy a single loaf of bread.
Which is crazy to even think about today.
Right, it is. But here's the really terrifying part. The part that fundamentally breaks a society's psychological anchor. By the time she actually reaches the bakery, the price of that bread has doubled.
Oh, wow.
Yeah, the literal weight of the money she brought is no longer enough to secure her family's next meal. The purchasing power of her currency is just evaporating into thin air faster than she can walk down the street.
It's a stunning, visceral image.
It really is. It's this image of economic collapse from history, but it serves as the perfect chilling prologue for the material we are going to dissect today.
It is a profound historical touchstone. And what makes that image so haunting isn't just the logistical absurdity of wheeling cash around, it is the instantaneous destruction of trust.
Yeah, the trust is gone.
Exactly. When money dies that quickly, the whole social contract shatters. But, before we get into the complex mechanics of how money loses its value, and more importantly, how different demographics are responding to that threat today, we need to establish the parameters of this deep dive.
We absolutely do. And to everyone listening, make sure you take a second right now to like and subscribe to the channel so you never miss out on these extensive discussions.
For sure.
Today's deep dive is an exclusive, comprehensive review of a highly provocative, ultra-long, and really fascinating new ebook.
Yeah, it's a big one.
It's called Inflation and Integrity, Men's Guide to Ethical Wealth Building, written by Conrad Reicher and published in 2025.
And if you want to engage with this material directly, we highly urge you to check out Amazon Kindle and Google Play Books to buy the book for yourself.
Yep, Amazon Kindle and Google Play Books. Also, make sure you follow the author at Conrad Reicher on Substack.
So the specific mission of this deep dive today is what makes it so compelling. Reicher's book is this incisive, heavily researched manifesto aimed specifically at men who are trying to navigate the modern financial landscape.
Right.
He takes a very hard, very critical look at the history of our traditional financial institutions. Reicher's core thesis is that he wants to help you understand the history and the foundational mechanics of these financial institutions before, as he argues, they were captured by modern narratives.
Specifically egalitarian, feminist, and Marxist ideologies.
Exactly. He is writing directly for an audience of men's rights advocates and those within the manosphere. He argues that these modern sociological shifts have fundamentally altered and, in his view, negatively impacted male financial leadership.
Right. And we need to be crystal clear right out of the gate regarding the nature of this text. This material contains highly politically charged viewpoints.
Very charged.
It is tailored toward a very specific audience and makes aggressive claims about gender dynamics, history, and economics. As your guides on this deep dive, we want to explicitly state that we are not taking sides.
No, absolutely not.
Nor are we endorsing these viewpoints.
Yeah.
Our goal is strictly to impartially unpack Reicher's arguments, to look at the historical perspectives and the economic data he presents, and to help you thoroughly understand the core message of his book.
We are here to analyze the text, pressure test his framework, and see what insights can be extracted from his worldview.
Precisely. Knowledge is most valuable when it's rigorously examined. Analyzing multiple perspectives, especially controversial ones, enriches our own understanding of the macroeconomic environment.
Yeah, well said. So let's start where Reicher starts his historical analysis, the concept of the inflation illusion.
The silent thief.
Right. Reicher completely redefines how the average retail investor should look at inflation. He argues that the mainstream media conditions people to mistakenly view inflation simply as prices going up.
Like a gallon of milk going from $2 to $4 over 2 decades.
Exactly. They look at a metric like the Consumer Price Index and think of it as a natural force like the weather.
Right, the standard explanation is always something simplistic. But Reicher forces the reader to look at the mechanics of the M2 money supply. He calls inflation a silent thief, a deliberate mechanism that erodes your purchasing power while you sleep.
And he takes it a step further than just Austrian economic theory. Reicher argues that inflation is not merely a macroeconomic phenomenon, it is a profound psychological weapon.
A psychological weapon, that's a strong phrase.
It is. He says it breeds fear, it breeds a pervasive sense of uncertainty, and ultimately it forces a high time preference.
Meaning people want things now rather than later.
Exactly. It forces people into poor short term decision making because they feel like they are constantly running on a treadmill that is speeding up.
Let's sit with that psychological aspect for a moment because it's crucial to his overarching thesis.
Yeah.
How does that psychological pressure actually manifest in the behavior of the average investor?
Well, Riker sets the tone in his preface by calling the book a call to arms.
A call to arms.
Yes. He is speaking directly to men who refuse to be passive victims of central bank policies or societal narratives. We have been conditioned by a highly specialized society to simply trust the experts, to hand our capital over to institutional managers while real yields turn negative.
Right, and Riker is pushing back violently against that complacency. He is demanding a return to strict integrity, absolute clarity, and an almost militant purpose in wealth building.
And when Riker talks about the silent thief of inflation, he isn't just talking about Weimar Germany in the abstract. He wants you to look at your own portfolio right now.
Yeah, he makes it very personal.
He does. If you are holding a heavy percentage of cash or low yield fixed income assets, Riker's argument suggests you aren't just playing it safe. You are actively participating in the mathematical erosion of your own wealth.
Because if the yield on your savings account is 2%, but real inflation is running at 8%, the social contract between the citizen and the state is essentially broken.
The destruction of purchasing power destroys the fundamental trust people have in their institutions. And that erosion of trust in the broader macroeconomic system is exactly the pivot point Riker uses.
To transition into his thesis on the erosion of male leadership within those systems.
You got it. He argues that historically financial institutions and family structures operated effectively precisely because they were guided by a very specific, culturally enforced type of stewardship.
Where he terms the masculine mandate.
The masculine mandate, yes.
So let's look at the mechanics of his argument here. Because he traces the lineage of men as financial stewards all the way back to the legal frameworks of ancient Rome.
He really goes back to the roots.
He spends a significant amount of time unpacking the concepts of the paterfamilias, the male head of the household who held patria potestas, meaning he had absolute, complete legal control over the family's wealth, property, and even the lives of his dependents.
And what's intriguing about Riker's interpretation of the paterfamilias is how he frames it. Not as a system of tyrannical oppression, which is the modern sociological consensus, but as a profound, uncompromising duty.
A duty. Interesting.
Yeah. In the Roman legal structure, the paterfamilias wasn't just hoarding wealth. He was the sole entity legally responsible for the debts, the survival, and the intergenerational transfer of the family's estate.
So it was about taking on the ultimate burden of responsibility.
Absolutely. If the estate failed, the paterfamilias bore the absolute ruin. And Riker traces how this mandate evolved through different economic eras.
Right. He moves from the agrarian economies where wealth was highly tangible like land, livestock, crop yields, into the massive disruption of the Industrial Revolution.
That was a huge shift.
Huge. Because before industrialization, most men were physical providers. Their physical labor directly fed their households. But the rise of factories and large-scale production changed the nature of wealth entirely.
It decoupled labor from direct survival for the first time in human history. Men shifted from just working the soil to becoming early capital allocators.
They had to navigate wage labor, manage early forms of equity, and deal with the intense abstract complexities of industrial capitalism.
And Riker argues this required a massive psychological shift. Men had to develop a new kind of cognitive stoicism to manage abstract financial risk rather than just physical environmental risk.
And if we follow his historical timeline, he points to the post-World War II era as the next massive inflection point.
Right, the post-war boom.
During the war, an entire generation of men gained incredible logistical, managerial, and strategic planning skills. They were managing global supply chains, troop movements, and massive industrial output.
But when they returned, the post-war economy shifted heavily toward a consumer-driven model.
Exactly. Riker speculates that this consumer boom, fueled by easy credit and unprecedented prosperity, caused a cultural shift toward immediate gratification and hedonism.
The long-term stoic stewardship of the past began to be subtly abandoned for the dopamine hit of short-term consumption.
It's a really fascinating lens. And to solidify this concept of the masculine mandate, Riker relies heavily on ancient religious and traditional texts to show that this isn't just a localized historical anomaly.
He views it as a fundamental human operating system. He cites the Jewish concept of parnasa, which roughly translates to livelihood or provision.
Framing financial responsibility not as a career choice, but as a deep, non-negotiable moral duty.
Yes. And he also brings in early Christian theology, specifically quoting the Apostle Paul in 1 Timothy chapter 5, verse 8.
Right. That passage states that anyone who fails to provide for their relatives, and especially for their own household, has denied the faith and is worse than an unbeliever.
Raker is using these texts to argue that this immense pressure, this mandate to provide and protect capital, is baked into our oldest, most successful cultural codes. It is a feature of civilization, not a bug.
To ground this in a more modern historical context, he dedicates a fascinating chapter to John D. Rockefeller.
Now, in modern academia, Rockefeller is frequently criticized for ruthless, monopolistic tactics. But Riker views him through a different lens, as the ultimate archetype of a man who utilized immense wealth to build a permanent legacy.
Riker argues that Rockefeller didn't just accumulate capital to consume it, he built the infrastructural bedrock, the modern oil and logistics industry that drove global economic growth for over a century.
He prioritized a massive multi-generational vision over any short-term popularity or immediate consumption.
So if this intergenerational transfer of financial knowledge from fathers to sons, this stoic stewardship was the engine of this historical system, what threw a wrench in it?
Well, that brings us to a core pillar of his book, his analysis and ultimate rejection of feminist financial narratives.
This is where Riker's arguments become highly polarizing.
Very polarizing. To construct his critique, he first meticulously lays out the historical trajectory of women in finance, acknowledging the historical constraints.
He notes that under the aforementioned Roman laws, and indeed under English common law, for centuries, women were largely barred from independent property ownership.
He tracks the evolution through the Industrial Revolution, noting the rise of wage-earning female factory girls, and then the massive societal shift during World War II with the Rosie the Riveter phenomenon,
where women proved their immense capability in heavy manufacturing and engineering while men were deployed.
Exactly. And he certainly doesn't ignore the suffrage movement either. He discusses figures like Susan B. Anthony and Elizabeth Cady Stanton, analyzing how they recognized that political power through the ballot box was inextricably linked to economic and financial independence.
Riker even highlights modern titans of industry. He specifically praises the leadership of Abigail Johnson, the CEO of Fidelity Investments, the entrepreneurial genius of Madam C.J. Walker, and the corporate dominance of executives like Mary Barra at General Motors and Ginny Rometty at IBM.
He openly acknowledges their sheer competence and alpha generation abilities.
But, and this is the foundational crux of his argument, Riker posits that while the initial goal of equality of opportunity was a laudable correction of historical legal barriers, the subsequent ideological push of modern feminism has negatively altered broader macroeconomic decision-making.
He points specifically to the Equal Pay Act of 1963 and the modern discourse surrounding the gender pay gap.
Okay, but look, let me push back on that for a second to play devil's advocate. The mainstream consensus is heavily weighted towards systemic wage discrimination as a persistent reality. How does Riker reconcile the empirical data regarding the wage gap with his claim that these narratives are inherently flawed?
It's a vital question, and he addresses it by arguing that the prevailing narrative intentionally ignores fundamental statistically verifiable differences in career choices and risk tolerance.
How so?
He cites extensive labor data suggesting that men are statistically much more likely to pursue high-risk, high-reward, physically dangerous, or extremely volatile careers.
Like offshore drilling or high-frequency trading.
Or heavy infrastructure.
Right.
Exactly. Conversely, he argues the data shows women on aggregate tend to prioritize job security, flexibility, and work-life balance.
So Riker argues attributing the wage disparity solely to systemic oppression, rather than the compounding math of differing risk-reward vectors, is intellectually dishonest and leads to bad economic policy.
That's his exact argument. And he doesn't just keep this critique at the macroeconomic level, he brings it right into the living room.
Yeah, he issues a very stark warning against the modern, socially accepted concept of shared financial leadership within a household.
This is where he brings in some truly provocative data. He cites a longitudinal study conducted by researchers at the University of California in the early 2000s.
What did the study find?
According to Riker's analysis of this study, households where men took the decisive lead in financial decision-making, specifically regarding capital allocation and investment risk, had a net worth nearly 20% higher than those households where financial control was shared equally or managed by committee.
Let's sit with that statistic for a moment.
Yeah.
A 20% difference in terminal net worth over a lifetime simply based on the decision-making structure of the household.
It fundamentally challenges everything modern financial planners and couples therapists advise today.
It really does. Why does he think that happens?
Riker theorizes that the push for egalitarianism in household finances inevitably leads to decision paralysis. He argues that men and women on aggregate possess different biological and psychological approaches to risk.
So when you require a consensus for every investment, the portfolio naturally defaults to the lowest common denominator of risk tolerance.
Exactly. The couple ends up sitting in cash or low yield bonds, missing out on the exponential growth of riskier equities.
He also aggressively criticizes the current landscape of institutional financial education. He highlights a recent industry survey which found that nearly 70% of new retail financial literacy programs are targeted exclusively at women.
He argues this creates a systemic blind spot, actively sidelining young men and undermining the vital historical importance of male financial education and mentorship.
To counter this, Riker clearly defines what he believes constitutes effective masculine financial leadership. For him, it is not about dominance or control for its own sake. It is about pure strategic thinking, aggressive and unsentimental risk assessment.
And crucially, the ability to completely ignore emotional impulses. He points to legendary capital allocators like Warren Buffett, Ray Dalio, and Peter Thiel.
Riker argues these men didn't build their empires by following social sentiment or managing by committee. They built them through cold, hard logic, contrarian thinking, and data-driven conviction.
Which brings us to Riker's highly controversial, heavily debated take on the 2008 financial crisis.
Oh yes. We all know the mainstream media narrative. Unregulated derivatives, predatory lending, and greedy men taking reckless risks on Wall Street caused the global economy to collapse.
But Riker attempts to flip this narrative entirely. He argues that the underlying rot of the crisis was actually catalyzed by federal policies that prioritize short-term social goals over fundamental financial stability.
He points specifically to the political push to aggressively expand homeownership to demographics that historically did not meet the stringent credit requirements.
Right. He argues that government-sponsored entities like Fannie Mae and Freddie Mac were weaponized by politicians who rejected traditional conservative underwriting standards.
Which Riker aligns with traditional masculine financial principles.
Exactly. They rejected those in favor of an egalitarian social objective. He argues that injecting social emotion and political mandates into the cold math of lending is what ultimately birthed the subprime mortgage crisis.
Which Wall Street then merely securitized and exploited. That is a fascinating contrarian lens to look through.
He is essentially asserting that whenever you inject social engineering into fundamental financial systems, the systems inevitably misprice risk and collapse.
And that premise serves as the perfect bridge into the core psychological framework of the book. Riker transitions from macroeconomic policy into the internal terrain of the investor.
Let's break down his thesis on the psychology of wealth and what he frames as the ultimate battle between stoicism and modern vulnerability.
Riker goes completely against the grain of modern self-help and psychological culture here.
Right.
Today's zeitgeist heavily promotes emotional openness, sharing your trauma and being vulnerable, especially for men.
And Riker presents a stark, unapologetic rejection of this. In the context of high-stakes environments, whether that is capital allocation, business negotiations, or legal battles, he calls vulnerability a dangerous double bind.
A double bind, meaning you're trapped either way.
Right. He argues that men are currently shamed by society for being traditionally stoic, yet the moment they actually open up, show weakness, or express vulnerability, they're instantly punished for it, losing respect and leverage.
He illustrates this dynamic with a highly detailed, rather devastating case study from the book. He tells the story of a man named Mark.
Poor Mark.
Yeah. Mark is a successful professional, a divorced father, who finds himself in a brutal, protracted custody battle.
And the modern psychological advice Mark receives from counselors and mediators is to be vulnerable, to share his feelings, and to show the court his emotional depth.
So instead of walking into the courtroom presenting a cold, rational, bulletproof financial and logistical plan for raising his children, Mark breaks down on the stand.
He admits he feels overwhelmed, anxious, and lost in the process.
And the legal outcome is catastrophic for him. The judge rules against Mark, severely limiting his custody. And what does the judge cite in the ruling? Mark's apparent lack of financial and emotional stability.
Riker uses this tragic anecdote to scream from the rooftops to his readers. In adversarial, high-stakes situations, emotional openness is not a virtue. It is a massive liability.
It signals a lack of control and undermines confidence. The world, Riker argues, does not reward men for their tears, it relies on their competence.
To provide empirical backing for this philosophy, Riker contrasts Mark's story with a comprehensive study conducted at West Point.
The military academy.
Yes. The military, by sheer necessity of survival, trains officers to suppress panic and emotional volatility in high-pressure combat situations. Emotional leakage in a firefight gets people killed.
Right.
The West Point researchers found that cadets who scored the highest on emotional resilience and stoicism tests, meaning they did not open up about their internal fears, but instead focused ruthlessly and mechanically on the execution of the mission, were statistically the most successful in long-term leadership roles.
And Riker takes this military doctrine and applies it directly to portfolio management. He brings incredibly compelling institutional data to back up this psychological claim.
Yeah, the Fidelity data. He cites a massive longitudinal data set from Fidelity Investments. This data analyzed the behavior of retail investors over a decade.
And what did it find?
It found that men who adopted a highly disciplined, stoic approach to their investing, meaning they traded less, ignored market noise, and did not react to volatility, outperformed their more emotionally expressive, highly active peers by an average of 15% over a 10-year period.
Let's think about the mechanics of that. That is massive. We aren't just talking about a slight edge.
Exactly. And for the cohort of investors who exhibited extreme emotional control, the ones who effectively forgot they even had accounts during market crashes, they outperformed by 20% annually.
20% annually.
Why? Because they avoided the two massive killers of compound growth: the tax drag of constant capital gains from trading, and the behavioral failure of capitulation, which is panic selling at the bottom of a market cycle.
That percentage difference is literally the difference between retiring in luxury and working until your body gives out.
He spends a lot of time dissecting the work of behavioral economists, pointing out the psychological enemies of wealth: cognitive biases.
Specifically, Kahneman and Tversky's concept of loss aversion, driven by fear and greed.
He uses the dot-com bubble of the late 1990s as the ultimate historical classroom for this. Greed drove rational people to pour millions of dollars into internet companies that had no profits, no revenue models, and sometimes didn't even have a functional product.
The euphoria was a contagion.
And then the pendulum swung with violent force. When the bubble burst in the spring of 2000, fear took the wheel. The Nasdaq lost a staggering 78% of its value.
Trillions of dollars of wealth evaporated.
And the investors who survived that decimation were the Stoics. They were the men who ignored the euphoric noise on the way up, stuck to their rational asset allocation models, and refused to let sheer panic dictate their actions on the way down.
You know what I found surprising, given his tough guy rhetoric, is that Riker actively recommends practices like mindfulness and meditation.
Right, but he frames it completely differently than the wellness industry.
Exactly. He doesn't pitch it as a new age spiritual awakening. He pitches it as a biological hacking tool to literally rewire the neurology of the brain.
He points to fMRI studies showing that regular discipline meditation thickens the prefrontal cortex, the exact region of the brain responsible for executive function logic and rational decision-making,
while shrinking the amygdala, the brain's fear center. He argues you must physically work out the logic center of your brain so it can override emotional panic during a market crash.
That concept of physically rewiring the brain to handle stress is the essential prerequisite for executing Riker's tactical strategies. You cannot deploy capital effectively if your hands are shaking.
Which brings us to his specific mechanics of wealth generation, tactical wealth building, and his deep dive into alternative investments.
Because once you have forged the Stoic mindset, you need to know precisely where to allocate your capital in a hostile macroeconomic environment.
Right, let's get into the tactical weeds. Riker starts with the absolute bedrock of finance: compound interest.
He attributes the famous quote to Albert Einstein, calling compound interest the eighth wonder of the world, noting that he who understands it earns it, and he who doesn't pays it.
While he assumes his reader understands the basic math, he emphasizes the sheer brutality of time. He shows that $10,000 invested at a 7% real annual return, with all dividends reinvested, grows to over $76,000 over 30 years.
It is the silent, relentless mechanism that turns disciplined, steady progress into exponential, intergenerational wealth.
However, Riker's tone becomes highly urgent when he addresses the current economic reality. He cautions that traditional buy and hold strategies, particularly the classic 60-40 portfolio of stocks and bonds, are currently under severe attack by structural inflation.
He warns against relying on what previous generations considered absolute safe havens. To illustrate this, he shares a powerful cautionary anecdote about an investor named Robert in the late 1970s.
Let's break down Robert's situation because it perfectly illustrates the concept of real versus nominal yield. Robert is exactly what the financial experts of his day told him was the safest, most responsible thing a man could do.
He bought a 30-year U.S. Treasury bond yielding a fixed percentage to secure his family's retirement. It was backed by the full faith and credit of the United States government. What could go wrong?
What went wrong was the macroeconomic environment. By the early 1980s, inflation had exploded into the double digits. The Federal Reserve under Paul Volcker had to hike interest rates to unprecedented levels to break the back of inflation.
As interest rates skyrocketed, the market value of Robert's older, lower-yielding bond plummeted.
And more importantly, the purchasing power of the fixed income he received was absolutely decimated by the inflation rate. His safe nominal return translated into a deeply negative real return.
The asset designed to protect him was actively bleeding his wealth dry.
But Riker highlights how Robert adapted, showcasing that stoic masculine trait of pivoting without sentimentality. Robert realized the institutional advice was failing him.
So he sought out a mentor, a hardened real estate investor named Michael. And he aggressively pivoted his capital into tangible hard assets.
He bought overlooked, distressed multifamily properties, agricultural farmland, and physical precious metals like gold and silver.
Riker provides the math. While the broader S&P 500 grew by a respectable 150% during that specific inflationary period, Robert's highly adaptive, tangibly backed portfolio compounded by over 400%.
Riker uses this to pound the table. In a high-inflation fiat currency world, you cannot rely on paper promises. You have to understand real yields and look beyond traditional fixed income.
Which naturally leads into Riker's extensive and highly technical exploration of modern alternative investments, particularly his focus on cryptocurrency and decentralized technology.
Now, Riker doesn't shy away from the extreme gut-wrenching volatility of crypto. In fact, he embraces it.
He views the digital asset landscape as the ultimate modern frontier where the stoic, emotionally regulated investor can extract massive alpha from the panic of the herd.
He maps out the wild historical swings of Bitcoin to prove this point. He takes the reader back to 2017, when the introduction of Bitcoin futures on the CME sent the price surging to nearly $20,000 in a retail frenzy.
Then came the brutal crypto winter, where it crashed back down to around $3,000 a year later, wiping out the tourists.
He then analyzes the market microstructure of 2020, discussing the behavior of institutional whales, massive entities holding tens of thousands of Bitcoin.
He details how a single whale moved $1 billion worth of Bitcoin in one transaction, completely disrupting the liquidity pools and sending the market into a frenzy of speculation.
And of course, he tracks the macroeconomic tailwinds of money printing in 2021 and 2022 that led to Bitcoin's incredible surge to nearly $70,000.
But Riker's point with all of these examples isn't to act like a crypto evangelist guaranteeing you'll get rich. His point is to highlight that this extreme volatility is the precise reason you need an iron stomach and deep specialized education.
If you are emotional, crypto will destroy you.
He demands his readers become essentially academic in their approach to these technologies. He advises investors to stay incredibly informed, recommending deep dives into industry-specific journalism like CoinDesk and The Block.
He tells his readers to closely monitor DAO, decentralized autonomous organizations.
Let's expand on that because the concept of a DAO represents a fascinating paradox in Riker's philosophy.
A DAO uses blockchain technology and smart contracts to execute organizational decisions based on token holder voting, theoretically removing the need for a centralized CEO or board of directors.
Riker advises studying DAOs as early indicators of where capital and governance tech are moving. He even suggests leveraging platforms like Coursera and Udemy to take rigorous technical courses on blockchain architecture, cryptography, and algorithmic trading.
Basically, he's telling his audience that you cannot just follow the herd on Reddit or chase meme coins. You have to do the grueling, unsung academic work to understand the underlying infrastructure.
And this emphasis on rigorous truth-seeking transitions us beautifully into the final major concept of the book: ethical investing and the brotherhood of rational men.
Because Riker makes it abundantly clear. He doesn't just want you to amass capital. He wants you to do it with a specific code of honor.
This is a vital, often overlooked nuance in his broader argument. Given his harsh rhetoric, one might expect him to advocate for a cutthroat Gordon Gekko style of capitalism.
But Riker explicitly rejects the 1980s greed is good mentality. He argues that purely extractive capitalism is a sign of low time preference and societal decay.
Instead, he posits that ethical investing is in fact a deeply masculine approach. It is about stewardship. It is about looking beyond the traditional nominal return on investment, the ROI, which he argues often fails to account for the long-term human, infrastructural, or environmental costs to the community.
He introduces his audience to the institutional concept of impact investing, but strips away the corporate ESG jargon. He gives this incredible detailed example of a private family office that built a diversified portfolio focused exclusively on developing frontier markets.
They poured significant private equity funds into microfinance institutions and sustainable high-yield agriculture projects in sub-Saharan Africa.
The mechanics of this are fascinating. Over a decade, this portfolio didn't just achieve solid risk-adjusted financial returns. The capital actually built tangible infrastructure.
It funded schools, it provided capital for clean water engineering, and it capitalized local entrepreneurs stabilizing regional economies.
Riker uses this case study to demonstrate that masculine wealth, when deployed with stoic logic and a long-term horizon, can be a massive stabilizing force for tangible, real-world good.
It is the modern equivalent of the Roman paterfamilias building aqueducts.
But to achieve this level of focus, to maintain this ethical integrity in a world of short-term temptations, Riker believes you absolutely cannot do it in isolation.
In a chapter dedicated to building what he calls a brotherhood, he discusses the absolute biological necessity of surrounding yourself with rational, survivalist-minded men.
He argues that iron sharpens iron, and isolation breeds weakness and poor decision-making.
He provides several real-world frameworks for these networks. On the high end, he analyzes the exclusive Tiger 21 group, which is a peer-to-peer network of ultra-high net worth investors and entrepreneurs.
These men meet behind closed doors to ruthlessly scrutinize each other's portfolios, tear apart their investment theses, and demand accountability.
The goal is to strip away ego and find the truth of the math.
But he makes it clear you don't need a $10 million net worth to build this structure. He points to the ethos of the Bogleheads online forums, where retail investors practice radical honesty about their financial wins, their catastrophic losses, and their savings rates.
He even advocates for the creation of local in-person syndicates or book clubs formed around foundational texts like Robert Kiyosaki's Rich Dad, Poor Dad.
The structural point is to actively curate a tribe of men that will hold you to a higher standard of logic and execution.
And within that cultivated tribe, the concept of mentorship is the backbone. Riker references Ray Dalio's management philosophy once again, specifically analyzing the culture of radical transparency Dalio built at the hedge fund Bridgewater Associates.
At Bridgewater, ideas are openly, sometimes brutally debated, and the best idea wins on its mathematical merits, regardless of the seniority or the ego of the person who presented it.
Dalio calls it an idea meritocracy. Riker challenges his readers to bring that exact same standard of radical, unsentimental transparency to their own investment groups and family structures.
To bring his argument on culture full circle, Riker profiles a figure he calls Mike, a prominent social media financial coach who operates within these male-centric spaces.
Mike actively and publicly pushes back against the pervasive modern sociological narrative of toxic masculinity.
Through Mike's teachings, Riker argues that masculinity itself, the underlying biological and psychological drive, is not inherently toxic. Rather, traits like physical strength, assertiveness, aggressive risk-taking, and unsentimental decisiveness are absolutely essential tools for effective leadership.
The caveat, and it is a major one for Riker, is that these formidable traits must be governed by an ethical code. They must be channeled strictly toward fiduciary duty protecting, providing for, and elevating the community.
Riker uses Mike's platform to summarize his ultimate message. We have an opportunity to influence the next generation, not by apologizing for our nature, but by being unabashedly proud of our masculine traits and deploying them to build lasting wealth.
It is an incredibly comprehensive, intensely argued, and undeniably polarizing framework. Riker spans ancient Roman property law, modern behavioral psychology, complex market dynamics, and aggressive cultural critique to build his case for a hard return to traditional male financial stewardship.
It is a text that challenges the reader to deeply examine not just their asset allocation, but the very cultural narratives they have internalized about money, gender, and duty.
We have covered a massive amount of conceptual ground today, dissecting everything from hyperinflation to the psychology of family court.
But before we sign off, I want to leave you, the listener, with a final provocative thought. Something that wasn't explicitly debated in Riker's book, but that builds directly on his warnings about the future of institutions.
Think about the sheer terrifying speed at which artificial intelligence and decentralized technologies are evolving right now.
In the next 10 years, the very definition of value in management might fundamentally change. If neural networks and algorithms can process risk and outtrade human logic with zero emotional bias, and if decentralized networks remove the need for human institutional leadership entirely.
Will the historical stoic human traits that Riker champions become even more incredibly valuable as a scarce human anchor in a machine dominated world?
Or will we require a completely new, unimaginable psychological framework to even survive the financial future? It is something profound for you to mull over as you look at your own portfolio and your own biases.
A truly fascinating, somewhat unsettling question to ponder as the technological landscape shifts dramatically beneath our feet.
If you want to read this book for yourself, examine his data, and dive into the deep end of Riker's strategies, we strongly encourage you to check out Amazon Kindle and Google Playbooks to buy Inflation and Integrity.
And make sure you tell him we sent you by following the author on Substack at Conrad Riker.
Finally, please remind yourself to like and subscribe to the channel to catch our next deep dive. Thanks for navigating these complex waters with us today.